If the stock market goes down, gold and silver go down. Okay, well, if you look at what's happened over the last couple months, it's been totally opposite to that. And by the way, the other thing I would be looking at in terms of what's the Fed going to do is not just the data points. And right now, the assumption is, well, we're going to have to drop.
Michael Oliver, the man who predicted major market turns, just revealed a shocking shift in momentum, one that could send metals soaring while everyone else panics. The gold-silver ratio just triggered something huge, and if you miss this, you might regret it for years. So, let's start the video and watch till the end.
Yeah, don't assume you've got to go back to a prior high. You know, that assumption is not proved valid. And there's another assumption that's been kicked into the gutter, okay? You know, I'm tired of hearing it. If the stock market goes down, gold and silver go down. Okay, well, if you look at what's happened over the last couple months, it's been totally opposite to that. Now, there was that one time where silver did puke with the stock market, but then it dusted itself off and said, you know what? I shouldn't have done this. So zoom, you're back up in the 32, 33 zone after being at 27.50. So it was a mistake on the part of those who sold. But gold didn't really flinch that much. And if you go back and look when the S&P made its highs, which would be like in January. In fact, we put out our first sell signal in the first week of January. And 2 weeks later, the market made a new high. S&P did marginally, and that was the top. Go back and look at what happened from gold through March, April, etc. Stock market from January through March, April, total opposites. And now, what's gold and silver doing over the last week or two? They're pulling back. What's the stock market doing? Rallying. So in other words, forget that notion going forward that we must move with the stock market. No. Yeah, that's the reality that generally prevails over time anyway. Not all the time, but to link the correlation between gold and an incident of a stock market sell-off back in October of 2008, for example, or the COVID sell-off in March of 2020, those are isolated, rare events. They're not norms. And so people make the mistake of remembering only those particular minor instances and treat it as a norm. And they should have learned over the last several months it's not the case. Gold will benefit from a stock market top. We've argued that all along. It hasn't waited for the top to go up. Obviously, it's been going up solidly for a year plus out of that prior range. And but when the stock market breaks, that changes the data points and also will change central bank policy in the Western world. And I think we'll start to see that with the Fed pretty soon. They got numbers today that allows them to twiddle their thumbs some more. Yesterday, they got numbers that weren't too great, you know, GDP. But the unemployment number today was okay, so they can twiddle their thumbs. And I think they enjoy that because they definitely want to, you know, shove it into Trump's lap. So they can say, well, we came to the rescue like a month or two from now when they start cutting rates. They could claim, well, he did it. We're trying to rescue it. But anyway, that aside, they will liquefy events. When the stock market breaks and the data points go, they'll go berserk again. And what does that do? That just helps degrade the value of the money you have by increasing its quantity. And that's what ultimately drives gold over the long term. I think it's in a briefer corrective process than we've seen prior to this. Over the last year, for example, if you'll look at what gold did, it moved up in layers and sometimes would be stuck in a horizontal zone for a handful of months. Go back to April of 24, for example. We said in March of 24, expect the beginning of the bull market again. In other words, it's been asleep for 3 years. And it's sure enough, it engaged, but it still had these layered, time-consuming zones of nothing, you know, where we just simply hold and absorb the selling and finally can go up again. Well, right now we're in the second week of a pullback, period. So in fact, it's not even a full 2 weeks because, you know, anyway, the number of days is a handful. And I suspect this will be brief. It won't be multi-month. I don't think we're going to correct like everybody seems to think. We're going down to 2,800. I think what people are doing or price chart is primarily, is when they project, oh, it's all over for now, we got to go back down to here. Every time they do that, what they're doing is they're finding the prior shelf of highs that was broken through, and then you get a surge, and they seem to insist that you must go back to that prior high to test the price high. And gold hasn't done that. Instead, it's pulled back, but never gone back to the prior high. And right now, the assumption is, well, we're going to have to drop $500 from the high to get down to 2,800. And, it's going to take a long time, et cetera, et cetera. And this derails people emotionally and a lot of them get out of their positions. And we made a point of that in the last weekend report. We showed, I think it was 2010-11 phase in the gold bull market then, where we were in the acceleration phase. And we circled all the times where you had these scary downside breaks and or congestion zones. And we posed a question at each of the breaks. We said, you got out, but did you get back in? Because usually, boom, if you weren't really precise, if you got out, you didn't get back in, unless it made a new high again, in which case you missed a chunk. You get the point. I think that's where we are. Silver's the wild child. When gold had a mild little pullback during that stock market break in the first week of April, silver had a huge break. It went from $35 to $27.5, much of that occurring in 2.5 trading days. And so if you look at a silver price chart, you wiped out the prior major low in December, which had halted. It had dropped from 35 down to just above 30, went back up to 35 by March of this year, and then puked through that low like it was the end of the world. And in a heartbeat, it went from 27.50 up to like 30.5, 31, 32, 33, and right now we're trading in the 32s. I suspect this sell-off doesn't have much more time in days and or price, and that we can see when we look at momentum, whether we're looking at real short-term silver gold momentum like day-to-day type momentum action, or looking at some bigger pictures, it looks like it's a setup for another surge. In other words, we're just having another pullback. And I don't think silver is going to have another puke. You don't generally have two of them. In other words, if you had one that washed everything out and immediately slingshotted back up into normalcy, you don't do it again. You've had your cleansing. So any people expecting a duplicate cleansing, I think they're wasting their time. Anyway, that's where I think we are. I think we'll come up out of here pretty shortly, and there are some structures overhead on momentum and even on price that say you get back up 34, 35 on silver again, watch out. You could really blow at that point, upside. I'm not looking at that factor. It's an interesting factor. Gold's been going up for over a decade. And now in the last year, suddenly we have this China situation where everybody has turned their focus like China's buying, China's buying, China's buying. And they try to report on it every week. How much did they buy? And in the other, we understand that just recently there was 1 million ounces sold, which isn't that much, in the bigger scheme of things, from Chinese, probably citizens, not the central bank necessarily. And everybody thinks that's all you get to watch. No, it's not. Gold moves on far broader trends in monetary degradation globally, not just U.S. money degradation, but global. I saw a report the other day that global money supply has gone up 200% over the last 15 years. 200%. Okay, meaning the quantity of money has gone up, therefore the purchasing power, the real buying power of those money units has declined. And for the dollar, going back to the 1950s, every single decade, look at M2 and see it went from here to here, do the percent, and you'll see that it almost doubles every decade. And even more so recently because of what happened with COVID. Also, since the 2009 bear low, they did QEs. Don't be shocked if they go back and do QEs again. And by the way, the other thing I would be looking at in terms of what's the Fed going to do is not just the data points, the economic data points, because they're going to go sour big with the stock market. They follow the market. They don't lead the market down. is the T-bond market. Something's wrong over there. Treasury bonds are normally another alternative place to put your money if the stock market is in trouble. And yet, since the stock market dropped 20% from January to April, and now has bounced, but the bonds haven't risen. They've tried repeatedly to rise in price, drop in yield. I'm talking 30-year bond futures, for example, not the short end of the market that the Fed controls, but the long end of the U.S. government debt market. It's a dog. Now, we even thought technically there was justification for T-bonds to participate with gold as an alternative to the fractured stock market. And we saw a nice surge. Back early this month, T-bonds shot up to 122 on the T-bond futures from lows down in the mid, 1-teens, 115, 114, etc. So there was a big surge in price and a drop in yields, but it crashed. T-bonds in 2.5 days went from 122 in price to 111. For T-bonds, that's a crash. That kind of percent drop, especially in 2.5 trading days. And since then, they bounced back up about halfway to that 122 high. And I think the best we've seen is about 117 or so. Right now, we're trading the 115s.
The markets are whispering secrets, and Michael Oliver is decoding them for those willing to listen. If you found value in this, hit that like button. Don't forget to subscribe and press the notification bell, because the next move in gold and silver might not wait. Stay ahead, stay informed. Thank you.